Good day, fellow investors. Now, on a recent gold video that we made, Dr. Weed is saying that if you're buying gold, you should hold oil too if you think currency will be debased. And my idea here is that currency is made to be debased, but protection in a portfolio depends on the price for that debasing, the risk and reward over time. And that's also what I want to discuss: portfolio exposure over time, how to build a robust portfolio. Because there is one certainty when it comes to investing, and that is that currencies will lose their value because those are made to lose their value over time. That's a given, and given the current debt levels, that might also be a faster situation than over the last 20 years. We can expect something like this when it comes to global currencies. However, when it comes to protecting yourself in a portfolio, that first and foremost depends on the price you're paying for something. And as I said, the hard part is to know at what speed it's going to be debased, when it's going to be debased, and what is the right price of the supposed hedge. Let's discuss a few examples to see how this might fit your portfolio. First, gold that we discussed. If you look at gold, it doubled already in the last half a decade, a little bit more, and now it's reaching all-time highs. But there is always a lot of sentiment, it's not producing anything, and usually when people start to get attracted by it, it's usually the wrong time. If you wanted protection, you want to speak about gold when nobody wants to touch with a 10-foot pole, but keep in mind it's not producing anything. Another asset that's very much discussed now, if we can call it asset, is Bitcoin reaching extreme highs. And I have a friend that turned, I think, over the last decade, 20,000 into a few million, and he says that yes, the price is still not high enough for where it will go at a certain point in time, so this will likely go higher, but given the current jump, it is time to start offloading if you bought at the right time for that portfolio positioning. Similarly to gold, it doesn't produce anything. And if, let's say, you have a 1 million portfolio, you have now 2 bitcoins in it, that's 130,000, and maybe it will double in the next 5-7 years, and then you have a little bit more exposure on that. But it might hurt you much more if it's 20K in July, and it has happened already more often on these bets, let's say inflation protection bets and lower interest rates going forward, that are now pushing things higher and higher. And when I see something like this, I'm always a little bit scared, because when you see a jump like this, it becomes the greater fool theory, where you need to sell it to someone else. Bonds are instruments of destruction, because they say inflation will be 2.5%. What if it is 3.5% over the next 10 years? Then your total return will be 0.7%, and that's practically nothing. If inflation averages 5%, you're losing money. Better answer is, of course, stocks, and people have been positioning themselves for lower rates or higher inflation for longer, and one of the ways to position yourself by owning businesses. Stocks all around the world are reaching, except for Asia, all-time highs, and businesses should give inflation protections, dividends. They can increase prices over time to justify for cost increases over time, currency debasement, but again, it has to be done at the right price. The current dividend yield is 1.4% for the S&P 500, and that's not very attractive, because if I look in Asia when things are cheap, as I did this week when I looked at the Hong Kong market, one of the 10 interesting positions, another 3 that I have in my portfolio, is First Pacific, not related to China, but this is Philippines and Indonesia, P ratio is 4, the dividend yield is 5.76%, and it owns necessary businesses in those countries growing at 6% per year. So that's something to think about when it comes to accumulating wealth over time. Yes, stocks go up because the Fed is printing money or the ECB will lower rates, whatever, but for me, my framework is that accumulating wealth equals to protection from currency debasement, but at a healthy risk and reward. This increase is not fundamental. The S&P 500 is also at all-time highs, but now this might be at all-time lows, an interesting risk and reward. The key question I want to have answered is that I build my portfolio over time, build so that I buy when whatever happens, my portfolio is robust, and that I increase my lower level of wealth over time, which means the following. So this is, let's say I have wealth 1 here, at the subsequent bottom I want to have 2. This is investing, and now no matter whether you are at 10 or 20 here, the key is that at the next bottom, this 2 is 4 or even more. That is, for me, investing, and you have to think about the assets that are going to bring you there slowly compounding over time at a healthy risk and reward rate. People are now chasing assets, gold, Bitcoin, stocks, bonds, hoping that rates will go lower and therefore this will go up into infinity, money printing, etc. But that is not what life cycle, long-term, accumulating wealth investing is about. So subscribe to the channel as we do exactly that, and we will discuss that more into the future. Check my research platform in the meantime.